Good day, everyone. Welcome to another edition of For Our Financials Financial Forum. And we've added back the finance and focus section. So we got a different way to present that this week. So we got all three back: markets in motion, finance and focus, and the wealth wisdom workshop, where we're talking about the viability of Social Security this week and the system and where everything kind of stands, to give you all some real facts on that. And we'll remind you about the webinar that we'll be doing in October about that, where we'll take a more in-depth look. But today we'll get started with Jeffrey with the markets in motion.
So welcome to the Markets in Motion as usual, everybody. So markets delivered a relatively quiet week overall, but beneath the surface, investors continue to weigh two of the most important factors driving markets this year, and that's inflation and economic growth. So for the week, the S&P 500 gained 0.36%, marking its third consecutive weekly advance, while the NASDAQ Composite rose 0.14%. Then the Dow Jones Industrial Average declined 0.56%, and then the international developed markets gained 0.26%. The week's primary catalyst was a pair of inflation reports that reinforced the narrative that price pressures continue to moderate. July's consumer price index showed inflation largely in line with expectations, while wholesale inflation, measured by the producer price index, came in cooler than anticipated. Investors viewed both reports favorably, increasing confidence that the Federal Reserve may remain on hold at its next meeting.
Yeah, technology stocks, particularly those tied to AI, resumed their leadership role as investors responded positively to that inflation data and the decline in oil prices. Those tailwinds helped support broader market sentiment and extended that recent rally in growth-oriented sectors. However, not all of the economic news was positive. Retail sales unexpectedly declined in July, suggesting consumers may be becoming more cautious with their discretionary spending. That report served as a reminder that while inflation is easing, economic activity is also showing signs of moderation.
Mm-hmm.
All right, so now we'll take a little bit deeper dive into that, and kind of unpeel and unpack what that overarching data is telling us. So now we'll jump into the finance and focus section, and Jeffrey will get us started there as well.
So the key takeaway from last week's market activity is that investors are increasingly focused on finding the right balance between falling inflation and sustainable economic growth. The environment creates both opportunities and areas to monitor closely. So let's starting us off. We got lower inflation continues to support asset prices. So markets are generally perform well when inflation moderates without a significant economic slowdown. Recent inflation reports suggest that pricing pressures are easing, which may reduce the likelihood of additional Federal Reserve tightening and support both equity and fixed income investments. Then that leads us into consumer spending bears I'm watching. That unexpected decline in retail sales is worth monitoring, to say the least. Consumer spending represents a major driver of economic growth, and any prolonged slowdown could eventually affect corporate earnings and business investment. At this stage, 1 month does not establish a trend, but it does warrant attention. Then we got technology and AI remain important market drivers, kind of business as usual there. Once again, artificial intelligence related companies played a significant role in market performance, while valuations in some areas remain elevated. Investors continue to reward companies perceived to be leading the next generation of productivity, innovation, and earnings growth. And I'll kick it back to Marcus to kind of lead us into a couple more.
So diversification continues to matter, as we all know. So while that technology leadership often captures those headlines, last week's results also highlighted the importance of diversification across sectors and across asset classes. Discipline over reaction. Perhaps the most important reminder for successful investors is that markets often move ahead of the economy. Daily headlines may alternate between inflation concerns, slowing growth, geopolitical developments, and earnings results, but long term wealth is typically built through disciplined planning rather than reacting to short term market swings. So the bottom line here is the market continues to navigate good news, cautious news environment. Cooling inflation is encouraging, but investors will be watching closely to see whether economic growth remains strong enough to support corporate earnings and sustain the current market advances. So now we'll switch over to the Wealth Wisdom Workshop as we discussed, and we're talking about the viability of the Social Security system, and what it means for your finances going forward.
All right, so to get us started with the Wealth Wisdom Workshop, like Marcus said, we're going over Social Security changes and how to protect your retirement income from future uncertainty. So let's start off with a question. When you think about retirement income, what is the one paycheck most that people count on? For many Americans, the answer is Social Security. Social Security serves as a foundation that helps fund everyday living expenses while allowing retirement savings to support travel, recreation, family experiences, charitable giving, and all the things on their bucket list. It's one of the few income sources that provides lifetime benefits and annual inflation adjustments. But today, more retirees and pre-retirees are asking an important question. Can I count on Social Security to look the same in the future as it does today?
So today we're not here to predict what Congress will do because we don't know, but we're here to understand the risk, the potential, identify the potential gaps, and ask whether our retirement plans are prepared if these changes occur. So why does Social Security matter so much? Its value comes from three unique characteristics: guaranteed monthly income, inflation adjusted benefits, and income that lasts for life. Few retirement assets have all three. So that's exactly why uncertainty surrounding Social Security creates so much concern. When one of the cornerstones of retirement income faces potential changes, it affects every other part of the retirement plan, even for successful families.
Hmm. So the first obstacle becomes long-term funding challenges. Um, According to Social Security's trustees' projections, the trust fund faced future funding shortfalls during the 2030s. So while Social Security is not expected to disappear, future revenues may not be sufficient to fully support all scheduled benefits without legislative changes. If no action is taken, benefit reductions of roughly 20% to 25% have been projected. That could present a meaningful reduction in monthly cash flow that affects housing, healthcare, travel, lifestyle choices, and just overall retirement security. Then it leads us to an obstacle two, which is uncertainty. The second challenge is simply uncertainty, and that legislative changes could affect benefits. Congress has several options available to address funding concerns, including modifying cost of living adjustments, increasing full retirement age, changing the benefit formulas, increasing taxation of benefits, and implementing means for testing for higher income retirees. The truth is that nobody knows exactly which challenges may occur, but history tells us that when a program faces financial pressure, adjustments are often part of the solution. Danger isn't necessarily one major change. The danger may be a series of smaller changes that gradually reduce retirement income over time. And that leads us to an obstacle three, which is small changes create big consequences. One of the most overlooked realities in retirement planning is the power of compounded. Most people hear 1% adjustment and assume it isn't significant, but retirement often lasts 25 to 30 years. Small changes repeated year after year become large changes. For example, a modest reduction in annual cost of living adjustments may seem insignificant today, but over 2 decades, however, the reduction could result in tens of thousands of dollars less lifetime income. That money could have been used for healthcare expenses, travel opportunities, family support, or just maintaining your desired lifestyle.
Yep, the biggest gap we see isn't necessarily a Social Security problem, it's a planning problem. Many retirement plans assume the following: benefits remain unchanged, cost of living adjustments continue indefinitely at historic levels, tax treatment stays the same, legislative changes never occur. Those assumptions are probably optimistic. A resilient retirement strategy doesn't rely on assumptions, it prepares for possibilities. The question isn't whether changes will happen tomorrow. The question is whether your retirement plan could withstand them if they did. So, the danger of doing nothing. Many people respond to Social Security uncertainty by simply hoping everything works out. And we understand why. After all, these issues are largely outside of our control. But doing nothing doesn't eliminate the risk. It simply leaves you unprepared for potential changes. The retirees who feel most confident are often the ones who understand their options, evaluate different scenarios, and build flexibility into their income strategy. Because while we can't control Washington, we can control how prepared we are.
And before we close today, I want to send a special invitation to our October webinar because Social Security is such an important topic. Today, we're only scratching the surface of it. In October, we'll be hosting a dedicated Social Security webinar where we'll take a much deeper dive into the topic. If Social Security is an important part of your retirement future, and for most people it is, you won't want to miss that session at all. So as we conclude, I'd like you to think about the retirement you've been planning for, the experiences you want to have, the family members you want to support, and the lifestyle you worked so hard to create. Now ask yourself, if Social Security benefits look different 10 to 15 or 20 years from now, would your retirement plan still work? How would it impact the legacy you want to leave? Because uncertainty is unavoidable. The goal is to ensure that the vision for your legacy isn't dependent upon the single source of income. And I think that wraps up today's podcast, Marcus.
All right. Yes, it does. So we'll see you all next week. Everybody have a good one.